All right, good evening everyone. We will go ahead and get started with this afternoon's webinar. We're going to be talking about trading intraday trends using the Mq Regression indicator and value bars. We'll also look at using the Mq Trend indicator as well alongside of Mq Regression as another filter. If you're new to these webinars that we do on Tuesdays, we typically try to keep them around 30 minutes long. If you have any questions throughout the webinar, feel free to submit them at any time via the side menu on GoToWebinar, and I will try to get to them as many as I can at the end of the webinar. If I do not get all your questions answered, feel free to send me an email directly at twood@microquant.com. Again, that's twood, W-O-O-D, @microquant.com. Before we keep on going, very quickly, we do have to have a risk disclaimer. All the examples I'm showing you are for hypothetical purposes. These are only for training. We're just trying to show you the strategy, teach you potential ways to trade the markets. We're not guaranteeing any results. You have to keep in mind that all trading has an amount of risk involved in it, and you should never be trading with money that you cannot afford to lose. Also, CFTC rule 4.41, once again, everything, all the simulated results that we're showing you are just that, hypothetical. Even if they were participated in us as trades, they are hypothetical. So the goal of tonight's strategy really is just to strategically enter into a trending market using Mq regression and value bars. Now we're going to be looking for intraday trends, so we're not finding end of day trends, we're finding the intraday trends, and we'll be entering using very short time frames like a 1 or a 2 minute chart. We're also trying to increase our reward to risk ratio by entering on the right side of value. So if it's an uptrending market, so if the market's trending up, we're entering in undervalued. If the market's trending down, we're entering in overvalued. By entering on the right side of value, we're able to get in the money much sooner. We're also able to use much tighter stop losses on the trades, so we don't have to have as much potential risk involved with the trade. Now, we're not trying to catch the entirety of a move. We're waiting for the trend to start, and then we're trying to strategically enter in there. So we're trying to catch the majority of a move, and we're trying to risk as small of an amount as possible. Now, what are the indicators that we're going to be using? First off, Mq regression, and second, value bars. Very simple strategy, very easy to do. What Mq regression is it's one of the, obviously, the Mq indicators from the Mq indicator suite that's in the value charts large bundle, and it's a simple trend indicator. You'll see the regression line, if it is red, it's trending down. If it's green, it's an uptrend. So obviously, if it's in an uptrending environment, you're looking to buy. If it's in a downtrending environment, you're looking to sell. The other indicator that we're using is value bars. All value bars is simply just like your value chart, but instead of plotting the movement of the value through the value zones, it's just superimposing it over top of your traditional open, high, low, close chart so that you're able to see the prices as it actually goes through the value levels. Now the settings that we're going to be using today, we'll be using a 7-bar analysis period on value bars. Pretty reactive, but not as reactive as a 5-bar. You can also use a 5-bar if you want, but we'll be using a 7-bar analysis period there. And then on Mq regression, we'll be using a 100-bar look back on the Mq regression for all the examples that we're going to show. Now what we'll do, we'll go ahead and we'll pull up TradeStation, and I will start showing you several examples just from today's market for how to enter into a strategic trend, into an intraday trend. Now you have to keep in mind, there's a couple things that the market needs to be doing for the strategy to work. First off, it has to be trending. You don't want to try strategically entering into a trend if there is no trend. So if the market's choppy going like this, it's not going to work anywhere near as well as if you're actually in a trending market where the market's heading higher. And I'll show you a couple examples, such as crude, where crude was trending up for the majority of the day. We'll also look at copper, where copper was trending up for quite a while. You can find very, very attractive entry points into those trends by drilling down to 1 and 2 minute charts. Now this is mainly a day trading strategy, so we're looking for intraday trends. However, the same thing can be applied to end of day charts or 120 minute or 240 minute charts. Same thing. You just have to keep in mind that the overall trend on a 240 minute chart may be down, and that market can spike up quite a bit before it continues on for that downtrend. So you have to keep in mind that there is a little bit more risk involved when you're trading on a larger time frame. You have to use a little bit more room with your stop loss. But for the intraday trades, you're typically only risking 4 to 5 ticks with your stop if you're getting into a truly trending market. So let's go ahead and pull up TradeStation, and we'll take a look at some trending markets and how you can enter into them. Okay, you can see my screen here. First, we're going to be looking at copper. Now what you're trying to do with this strategy is enter in after the trend has started. You're trying to find a strategic undervalued entry point. So we all know copper was taken off and started trending up higher. So we're looking at first our Mq Regression, which is this red and green line here. Red means downtrend, green means uptrend. The second indicator that we're looking at is the Mq Trend, which is another different indicator. It uses a different way of detecting the trend. And you can see the regression line rolls over from uptrend much sooner than the Mq Trend does. So the Mq Trend will help you catch longer trends. The Mq Regression will help you get in sooner. But when they're both in agreement, you're normally looking at a pretty good trend as long as the market's going to be moving. Now what you don't want to see is choppy periods like this where the market's up, down, up, down. You don't really get very good trending environments. Now you can still be profitable doing this, because what we're looking to do is if it's in an uptrending market, we're looking to buy right there where it's undervalued. As soon as it dips into undervalued, the market's trending up. So we're a buyer right there, or we're a buyer on the following bar. So if this dips down and undervalued and then the next bar is up, we're buying on the open of the next bar. So you can either buy undervalued or you can buy as soon as it starts rolling over. Now there's a couple different things you have to pay attention with that. If you're buying as soon as it rolls over, you're more than likely going to have not as good of a fill. However, the market has already confirmed that it's going to be continuing on in your direction. So you don't get stuck in a point where the market is actually reversing and coming down like this. So it's really up to you and your personal preference for trading, how much you want to risk and how you want to be trading that. But one of the things that I like doing is waiting until it starts rolling back over, so you're not trying to catch it if it's reversing trend like that. Because you have to remember that in a downtrending market, you're expecting to see undervalued prices, and in an uptrending market, you're expecting to see overvalued prices. Just because it's hitting overvalued in an uptrending market does not mean you're supposed to arbitrarily be selling overvalued. You have to take it into context with the overall market and the direction that it's headed. In fact, if it's an uptrending market, it's a good thing to see overvalued prices, because that means it has strength to the upside. When it starts getting choppy and you start trading back into fair value or even undervalued in an uptrending market, you have to be very careful, because that could mean that the trend is coming to an end. So the first option is buying as soon as it dips into undervalued right there. The second option is buying once it rolls over. So once the market has confirmed it's going to continue on back in its direction. So what you're looking at, we had the breakout here. So it broke out. We were essentially range bound for a while in between the lows and the highs here. And it broke out to the upside. So now you're in the uptrend. Both your trend index is headed higher, and so is your regression. Remember, green line on regression means uptrend. Green dots on MQ trend means uptrend. So you're in the uptrend. Now you're looking for a strategic entry point. Your first entry point is right there where it dips down right into undervalued just barely. Your second entry point is going to be right there where it dips right down into undervalued just barely again. Now the better entry on this one, in my opinion, is here, because there the market actually rolled over and it was undervalued while it was rolling over and heading back in the up direction. You can see this bar closed higher than the open, which is what you want to see. And I'll try to highlight that for you. Right there, this bar closed higher than the open, so the trend was resuming and you were also moderately undervalued. So you had an uptrend, you had an undervalued price in an uptrending market, and your trend had started to resume higher. So you're getting long there, and then what you're doing is you're risking the low. So you're putting your stop 1 or 2 ticks below the low of your entry bar. Same, for example, here. You're putting your stop loss 1 to 2 ticks right below the low of your entry bar. So here's your first entry, and then the second box is your second entry, where it's dipping down into undervalued, and then you're resuming on your direction. You're putting your stop 2 ticks below the low. Now, if the trend's going to continue, it should never hit your stop loss. You can see, even if you had your stop just below this low, you probably would have been able to stay in that trade, and you wouldn't have gotten stopped out here. And that would have allowed you to catch the rest of the majority of this move. So you would have gotten in at 3.53 and carried it all the way up until your trend ended, which is where your regression line rolled over, or you could have been looking for a divergence, which, give me 1 second, and I'll show you what the divergence would have looked like. Typically in the trading room, we use momentum indicator, the MQ momentum for the divergence, but our divergence would have been right here, where we had higher prices, and if you looked at your indicator, you had lower highs on your indicator. So you would have had the divergence, so you would have been closing your long position there. That would have gotten you out right at the end of the trend. Would have been a great place to have exited, and again, you got in right at about 3.53, and you were getting out up around 3.57, call it. So very nice move there. You took several $100s a contract out to the upside, and you were only risking about 5 ticks with your stop loss, if that. So you're risking less than $100 a contract, catching a very nice move to the upside, and you were able to take out the rest of that trend. Now, the other exit opportunity, you have 2 different exit opportunities other than looking for the divergence. Now, divergences are kind of hard to identify at first. If you want to learn how to trade the divergences a little bit better, we will be having the divergence workshop coming up here in April. One of the best ways to trade, in my opinion. It's a great strategy. We use it all the time in the trading room, and you can sign up for that at valuecharts.com if you want to learn the ins and outs of trading divergences. You can find some very low-risk trading opportunities there. But your second options for exiting are just exiting when the trend ends. So you can either exit as soon as your MQ regression rolls over from uptrend to downtrend, so where it crosses from green to red. So you're going to go ahead and get out there. Or you can wait until your MQ trend ends. And the MQ trend ended and switched from uptrend to downtrend right there. So either of those would have gotten you out at roughly the same spot, either the regression or the MQ trend. The trend typically gives you a little bit more time with the way that it's designed to catch the trend, so it tries to catch a bigger move where the regression is going to roll over much sooner and get you out a little bit earlier. So those are your exit opportunities. Now again, you got to make sure that the market is actually trending, because you don't want to get into a market that's just chopping up and down, because then you'll just get chopped up. You might be able to take a couple $100 out at a time, but really you're not going to catch any big moves, which is what the goal of this is to catch some big moves. So the next market we'll take a look at is crude oil. Again, we'll look at it, what happened in today, where we had nice uptrend in crude oil. Again, you were essentially in a channel here coming across. You had your resistance was going to be either this high initially. Once that was broken, it was a false breakout, so you had your second high there, which became your new resistance. And here's where those highs are. First high for resistance, second high for resistance, and then your support is the lows, either coming across here from these lows, or the all-time lows, you're looking at support down there. You actually had an inverted head and shoulders pattern here as well on a 2-minute basis. Now, what we're looking at, let me remove some of these lines on here. Crude oil had a very nice move today. Again, you can wait and either trade with the MQ regression or with the MQ trend. or you can try to get them while they're both in agreement, meaning they're both heading higher. You can also wait and only trade it after the breakout. So once it broke through this high, you're looking for an undervalued entry. Now once again, you can either buy it as soon as it hits undervalued, which is a lot of times a little bit more risky, or the second opportunity you can do is wait for it to dip undervalued and then buy it as soon as it resumes direction, risking the low of that undervalued tip. Now let me try to get a little bit closer so you can see here. It moved pretty fast, so you gotta be careful. You had one undervalued entry point right there. It barely touches down to undervalued. You had your second entry opportunity right here where you had three undervalued tips right in a row. So you could either have been buying on the following bar when it started ticking back up in your direction, risking the low of this bar or two ticks below it, or you could have been looking here and waiting to buy either as soon as it hit undervalued or wait until it resumed back up in your direction and you're risking just below the low. Either way, it's getting you long from just around 92.09, call it, and you're holding it until the trend ends. So it ended with your regression line all the way up here, which corresponds to these price bars here. So your 92.09 is where you're getting in. You're out at 93.11. So you took $1,000 a contract to the upside right there, and you only risked about $50 with your stop loss. Again, what the goal of any strategy is, and what your goal should be as a trader, in my opinion, is to risk as small of an amount as possible to earn as big of a reward or as big of a return as possible. You also had additional entry opportunities. You could have been looking up here. You dipped right down into undervalued right there. You can see the lower end of both of those bars were undervalued. We had both of our indicators in an uptrend, so we had the okay to get long as soon as that bar resumed moving in our direction, or as soon as it hit undervalued, either one. That gets you long right around 92.68. And again, you have the ability to take out around $400 a contract to catch the rest of that move. The second option after that one is getting in at any of these undervalued price points. So you're waiting for it to come undervalued and then roll over and start moving back in your direction, and then you're going long, risking the low of that undervalued bar once it starts moving in your direction. And then once again, you could have identified the high here because you had another bearish divergence with these prices there, where you came up and you had just about equally high highs with a lower high on your indicator. Again, you can learn that in the Divergence workshop. That's another story for another time. Now, once the trend ended to the upside, we could be looking for a downtrending market. So once more, now you're waiting for our regression and our trend index to both be in agreement. So as of this point right there, we're in a downtrend. So we're waiting for overvalued prices, and then we're waiting for it to roll back in our direction. They don't actually resume the trend until right in this area. So you have the okay to get short right in here, risking just beyond the highs. And then you can catch the rest of that move either using the trend index or the Mq regression back to the downside. So you're getting short as the trend rolled over all the way up from around 93.10 or even 93. And then you're getting out right around 92.50, which is going to give you around $500 a contract in profits. And again, you're only risking about 100 to 150 a contract with your stop loss. Now, the markets that you do want to be careful about are the very choppy ones. Let's take a look. Soy was pretty choppy today. So look at what soy did, and you can see the price action today, how choppy this was. This is why I'm saying you have to make sure it's an actual trending market, because when a market's not trending, it's just spiking high and low like this, you're going to get a lot of noise. You're not going to have very many profitable trades. It's going to be very hard to get in and catch a good move if the market's not actually trending. There's a couple different ways you can try to verify that it's trending. First thing that we do in the trading room is we look for the direction that we want to be trading. So we'll look at a longer time frame We'll say, okay, we have a bullish outlook or a bearish outlook, and then we'll wait for prices to really start moving. And that's how you're going to verify the trend. So you have a bullish outlook, you have a bullish divergence on a longer time frame. You look at the 2-minute chart and wait for that breakout to occur. Once that breakout occurs, then you can trade it in the direction of the trend. If you're looking here at soy, here was your support and resistance. You never really had a breakout. It just bounced off the highs and the lows all day long. Where with the other ones, we want to have the breakout, i.e. with crude, we had the breakout to the upside. With copper, we had the breakout to the upside. We can also look at gold today. Gold had a very nice up move today. You could have been trading this off of the undervalued entries. So our trend is up as of this bar right here. That's where both our trend, MQ trend, and MQ regression are in agreement to an uptrend. We see the big spike. So we broke out of the resistance levels. Here was our resistance. Here was our support. Once we broke out of those levels, we're looking for the undervalued entry, which gets you long right there, or it gets you long right there, where both of those came down into moderately undervalued. That gets you long for the first one from around 1588, or let's just call it 1589. That trend continued on up until you had the bearish divergence. You actually had a bearish divergence right here before it pulled back a little bit. Then you had a double bearish divergence with the higher high prices. So you're long from 1589. It goes all the way up to 1596. So you're up about $800 a contract to the upside for the first entry. The second entry, you're in it from about 1591. And again, you're out either when the trend rolls over, which is going to be right here, or when you have the bearish divergence and you look to get out. You could also have waited and looked for the 15-minute bearish divergence that we traded in the trading room, where we went short right there to get out, to exit your position, where you had a longer time frame that you were looking at for the reversal. Either one of those would have been great trades. You had a very profitable entry. You didn't have to risk but about $100 a contract, if that, depending on what your entry was and when you were getting in. And you were able to take out several $100s to the upside, which is what you want to see. Now what I'll do, I'll go through and I'll answer as many questions as we can very quickly. Again, it's a very simple strategy. What you're doing, just to recap, you're waiting for the breakout. So you're looking at your support and resistance. Then you're looking at the trending indicators, your MQ regression and your MQ trend index. Once they're in agreement, you're looking for an attractive value-based entry. So you're looking at undervalued for uptrend or overvalued for downtrend. You're going long or short as soon as the trend resumes in its direction. So if it's an uptrend, it goes undervalued and then starts ticking back higher. You're buying, risking the low. Or if it's in a downtrend, you're going short once it goes overvalued and starts ticking down. You're shorting, risking the high. So very simple, allows you to catch the second half or the second 2/3 of trending markets on intraday trends. And you're using, again, this is a 2-minute chart. You can also use a 1-minute chart or a 5-minute chart, depending on the significance of the trend. What were the two settings? MQ regression is set to a 100 bar length, which is the red and green line. MQ trend is set to the defaults, which is 21, 21, and 4. And then value bars are set to a 5 or a 7 bar analysis period. This is set to 5. 7 will be a little less reactive, and it will not highlight as many entry opportunities. What is the blue moving average time frame? The blue line is what we call the gravity line in the live trading room, and that's just an 8 exponential moving average. We use it for candlestick reversals. And I typically have that on all of my charts. How can you utilize two time frames to take advantage of the undervalued in an uptrend or the higher time frame? What you can do is you can drill down. So you get your outlook, for example, with gold. We were looking at gold for a trend line break. We've been following this trend line for a while now in the trading room. So we're looking at gold for a either 120-minute or 240-minute chart, and we had a trend line drawn coming across all of these highs, and we were watching it. We've been watching it for the past several days in the live trading room, saying if it breaks, it can run. And so you're having a longer term bullish opinion because it's breaking in a longer term time frame. Then you're drilling down to that 1 or the 2 minute chart and entering off of the 1 or the 2 minute undervalue point, because you can see it never went undervalued on the longer time frame. It was just overvalued the whole way while we were having the value migration. But when we drilled down, you got to remember that value is time dependent. So just because it's overvalued on a 120-minute basis does not mean it's overvalued on a 2-minute basis. So you're finding a 2-minute or a 1-minute strategic entry on a 120-minute price move. Is the dotted line on the price chart a trend line? Are you talking about MQ trend, these red and green dots here? That's one of the microquant indicators. It's in the large bundle. It's just a trend indicator. It's called MQ trend. How do you possibly monitor multiple instruments across so many time frames, i.e. 1 minute, 2 minute, 15 minute, 30 minute, etc.? If you come to the live trading room, we actually do a pretty good job of monitoring multiple time frames. You can only see one screen. However, I have 8 screens that I'm following with all the charts on it while I'm hosting the trading room. This is what we typically have set up in the trading room, where you can actually see is you're looking at the 60-minute, the daily. This one up here is normally a 15-minute chart, and this one is a 30-minute chart. And they'll also have 240, 120, and weekly charts on other screens, as well as multiple other markets on other screens. And we'll drill down. We have a list of the symbols that we follow, and as we're looking at it, if we'll drill down to it, and I'll look at it on intraday prices, because I also have a 5-minute chart that I follow at the same time. Whenever I click on the symbol here, it'll pop up a 5-minute chart on my other screen. So that helps pretty well. That's how we follow so many time frames at the same time. We do a pretty good job of doing it so far. We haven't had any problems. What are the best trending markets to use this on? Honestly, that's a good question. You can use it on basically any market. Again, you got to look at your outlook. So you're looking at the bigger picture. I have a bullish outlook on gold. We have a bearish outlook. So for gold, we were looking at the trend line break. So we said, okay, we're bullish. So you're looking for a longer term move to the upside. You can use it with any market though. The more choppy markets, honestly, the indices are pretty choppy. They can be trending sometimes, but a lot of times they're very choppy. For example, the other day, the stock market just steadily chugged higher all day long. It didn't really do much, just up, 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 up all day long. That's a great trend to be trying to get into, and that was yesterday. If you look, you can see it right here on the 60-minute chart. All it did was steadily trend higher. Now, as I mentioned, you can do it on a longer time frame, so you can use the same strategy on a 60-minute chart. You just have to remember that your risk is going to be more because you're risking below the low. For example, you had uptrending market here in the S&Ps on the 60, where both your regression and your trend index were to the upside. You had undervalued entry points right there. You had undervalued entry points right there, undervalued entries right here. And again, you're doing the same strategy where you're entering as soon as the trend resumes and then risking the low. So you can use it on a longer time frame. Was it useful in the past move on the yen? If you look at the yen, are you talking to the upside or the downside? Because the yen has been trending down for quite a while, but we did have a big upsurge last week. If you look at the yen, you can use it. Let's take a look at a daily chart on the yen. So the yen's been trending down. Let me actually adjust this analysis period a little for ValueBars. It's already set to 5. The yen's been trending down, as you know. So you can look at the yen. Let me insert the trend indicators, Mq Regression and MQ Trend. So we're saying, okay, the yen's in a downtrend here. So you're looking for strategic entries on the daily. There's an overvalued entry point. Here's an overvalued entry point. Here is an overvalued entry point. Here's an overvalued entry point, and the trend is still down, still has it in a downtrend. So again, you can use it on this in all the markets on whatever time frame you want. The strategy stays the same. You just have to remember that the longer time frame, the risk is going to be more because you're risking beyond the high. The crossovers of the Mq regression line provide a better exit. It really depends. Like I said, the Mq regression is much more reactive. So you can see here, this entire time, the trend, Mq trend, had it in a downtrend through this whole period. If you're using the Mq regression started your downtrend there, ended the downtrend here, and then resumed the downtrend over there. So there was this period right here where the trend index kept you short, but the Mq regression would have gotten you out a little bit earlier. It really depends. Like I said, it's up to you how you want to trade it. The regression is going to be more reactive, so you'll get out of the trend a lot sooner, but you can miss moves like this, where the trend index would have kept you in it. How do you get that dotted trend on the price chart rather than the pane below? You just click it and drag it up to the chart above and click on same as price. I believe that's what it says. The settings for MQ trend are default. It's 24, 24, or 21, 21, and 4. Excuse me. How can you attend the live trading room? We offer free access to the live trading room every other Wednesday to all the subscribers to the free newsletter. If you go to valuecharts.com and subscribe to the newsletter, that's for free. It's right on the home page. You'll get access every other Wednesday. The next open house to the live trading room is next Wednesday, so the 20th. The price for the live trading room is $149 a month. As a subscriber to the trading room, for example, you get benefits such as a discount on the Divergence workshop. You get $50 off of that. Different things like that. We all try to offer discounts to people that are subscribers to the trading room for workshops. Do you trade off of 1 or 2 minute charts? Yes. Trade off of 1 and 2 minute charts all the time. Does it work in currency? Yes, it works in currencies. You're talking about just currency swaps, i.e. euro dollar, if I can type correctly. Actually, currencies are very good for this type of strategy because currencies tend to trend pretty well. A lot of times you'll get some pretty nice trending markets with currencies. The trading room is great. Thanks, Rob. But yes, you can use it for currency pairs as well. Again, the strategy applies the same. One of the great things about technical analysis is you can almost pick it up and use it for any market out there. Technical analysis stays the same no matter what market you're looking at. For example, in the yen, when the trend was down, how can you use the 60-minute chart to enter knowing that the daily has a massive downtrend? Very easily. Let's go back and look at the yen. Let me add some additional days back. What you're looking for is an overvalued entry point in the yen. You can see as the yen was coming down here, you had a lot of overvalued entry points that you could have been trading. While the daily stayed in fair value, the yen came down overvalued. Now this is where using a longer analysis period can be useful. So if you even use the default settings of 14, we know the daily trend is down. We're looking to enter off of the 60, so we're looking at overvalued entry points here. Again, you're waiting until the market rolls over. Overvalued entry right there. Overvalued entry is here. Overvalued here. And as you know, the daily trend is down, the daily stayed in fair value, but the hourlies poked up into overvalued and gave you options to get in. And then you can manage the trade based off of the daily. So you don't have to risk as much because you're getting in off the 60-minute chart, and then you're managing it as long as the daily downtrend is continuing on. So you're entering off of here, then you're looking at your daily and you're saying, okay, the daily's still in it, so I'm just going to hold on to that short until the daily trend ends. This does work on NinjaTrader. You missed the webinar from last week. Is it posted in the archives? It's not in the archives yet, I do not believe. It will be uploaded to the Value Charts YouTube channel. All right, if there's no more questions, I'm going to go ahead and end the webinar for tonight. Again, like I mentioned at the beginning, we try to keep these webinars pretty short and to the point, around 30 minutes in length. We've been going for about 40 minutes now. I hope everyone enjoyed it. We'll be trading this strategy in the trading room here tomorrow, so we can actually use it in action for those of you that are members of the live trading room. We'll be trying to use this strategy as well as the other ones that we use, such as the divergence trades, and that way we can actually see the strategy in use in the market while it's occurring. So I want to thank everyone for coming. That concludes today's webinar. Look forward to seeing many of you in the trading room tomorrow. Trading room rocks. Thanks, Cliff. And look forward to seeing a lot of you in the divergence workshop as well. Hope everyone has a great night. I want to go ahead and conclude the webinar.